All right, yes. So first of all, before we dive into the video, if you've been waiting for this video, because the videos are on a day-to-day basis, then I would highly advise, and I would suggest as well, recommend even, that make case studies on the videos. As in, if you have 24 hours before the next video is online. So in that time, if you have the time, of course, and even if you're watching not in the current enrollment and you're watching in an older enrollment, then take your time to watch one video and then move on to the next video. Don't watch the forecast just yet, the breakdowns just yet. It is your first enrollment. Only focus on that video for that 24 hours. After this enrollment, then you can go into the forecast, breakdown, whatever you want to do. But for this 24 hour and every 24 hour afterwards, focus on the next enrollment video. So the next video on order flow, for example, only focus on order flow for 24 hours and then move on to the next thing, And that is how I would recommend you to go through it. So if you have nothing to do, you're waiting a little bit, then watch the video again, make a case study, for example, share it with me. That is how I would go about it, and that is very important. So next thing is, let's dive into the video. So in the previous video, we touched on PD arrays. Again, premium and discount arrays. Why did we touch on the PD arrays? It's because the PD arrays, they are everything. As in, they create the story of price action. Without PD arrays, we don't know where to start. We have nowhere to start really without PD arrays. So the PD arrays create also the foundational levels. The foundational levels are, again, in the top right, we can see bias, narrative, boundary, target, entry pattern, and the risk management. So the PD arrays, they create everything. Now, what is the next thing that we need to understand is we're going to build onto that ID with fair value gaps. Because as discussed in the previous video as well, is that the PD arrays are nothing without fair value gaps. So it's almost like fair value gaps are the superior PD array. Because an order block is not high probability without a fair value gap. A mitigation block is not a mitigation block without a fair value gap. So everything relies on fair value gaps. They are the basis, they are the foundation of the market movements itself. And also the reason why they are so important, the fair value gaps, because if you know me, and you've already seen on YouTube a little bit maybe, then you know fair value gaps are the most important PD array to me by a mile. They are extremely important to me. And the reason for that is because they tell you every foundational level. They tell you the full story in itself already without needing the other PD arrays. They tell you a bias, a narrative, a boundary, a target, an entry pattern, and a risk management approach. So then why did I go over the other PD arrays in the first place? Because the other PD arrays allow you to have more accuracy. So fair value gaps in itself without the other PD arrays again can be used, but the other PD arrays can't be used without fair value gaps. So that is why the fair value gaps are the most important to me. But the other PD arrays allow us to have more accuracy to know which high is getting swept, which low is getting swept, to know which high is acting as a support level, which high is acting as a resistance level, where can we go higher from, which high is getting respected, etc. All those things to have more accuracy overall, because that is what we want, of course. That is very important. Now, the next part is if we want to understand fair value gaps, then we need to understand the why as well a little bit. Now, I need to define everything currently. So if it's a little bit boring and you already know it, then bear with me, because this is extremely important to understand first fully before we can dive into the very advanced stuff. So a fair value gap is intention. Why is that? Because we understand, with theory that we use, is we understand that there's a bigger player in the game. As in, there's a bigger player with a lot more volume, a lot bigger lot sizes than us that are moving the market. So when they are moving the market right there, a fair value gap is being created. So when the big player wants to actually move the market and wants to buy something, in order for them to buy, they are leaving behind that volatility. They are leaving behind that intention. So they are leaving behind a footprint, a clue in the market of where the market wants to go towards. And that creates a fair value gap. So they have so much volume, so much size that they can't do it without leaving behind traces. That is important. And that creates an imbalance in the market. And with an imbalance, that I mean not imbalance, I mean an imbalance right there. So that imbalance right there, of course, needs to be balanced, which again, another word for imbalance is just, again, that fair value gap. Another word for fair value gap is imbalance. So when we leave behind a fair value gap, we need to offer fair value. When we leave behind that imbalance, we need to balance it again. It's the same thing. It's the same exact thing that I'm talking about right there. So understanding that, then we can also understand, all right, since they are leaving behind traces, they are the bigger player, they are moving the market, then that means that the thing they want, where they want to move towards, is what's going to happen. So that means that is the intention of the market. That is the direction of the market, which leads us to the bias, which we're going to touch on. Now, right here, let's first understand the next thing is, again, the 3-candle pattern. Because understanding the 3-candle pattern of the fair value gap, and again, that might seem very basic, but this is something you need to understand, because this is going to be extremely advanced. So right here, we understand 1, 2, 3. That creates a fair value gap. Once the 3rd candle closes right there, it creates the actual fair value gap. So the first and the third candle. So the first and the third candle can be an expansion phase, can be a consolidation, whatever it is. As long as we understand that the second candle of any fair value gap being created is always the expansion phase. So this second candle creates the body of the fair value gap right there, because that is the expansion phase of a fair value gap. That is important to understand. And then the third candle again creates the actual fair value gap. So when I say that we are creating the expansion phase, or we are seeing the expansion phase of a potential fair value gap, then I'm referring to that second candle right there of a potential fair value gap. So a fair value gap where the third candle has not even been created just yet, because that will add on to something that we're going to touch on later on, is that the market is already taking into account and it's already predicting where the next fair value gap is going to happen. It already knows where the next fair value gap is going to be created. So we also need to know where the next fair value gap is going to be created. So that is how we can view that, is through the 3-candle pattern. And that is how we can know where the fair value gap is going to be created. All things we're going to go over. So again, we touched on the fair value gaps being intention. So if we look at these fair value gaps right there, we have bullish fair value gaps. They are getting respected, and we create new bullish fair value gaps of those. We trade into those right there, and then we continue higher. And that is what we're constantly doing right there. And eventually to the right, we continue higher right there. All right, so if we just followed the bullish fair value gaps right there, then what did we do? We knew the direction of price. The direction of price is your bias. So the first foundational level we have already gone over. Of course, we're going to go way more in depth than that, but the bias is the first foundational level. It's the first thing in your trading. Where is price going to go to? How can you know where it's going to go to? By just fair value gaps. Now, how can you exactly know that? Of course, everything we're going to touch on. But bias equals direction. Direction of market equals price, equals bias, sorry. So the direction of the market is either bullish or bearish. So where are we going to go to? Bullish or bearish? All right. Then if we are bullish, then we want to see bullish fair value gaps, of course. If we are also bullish and we have a bullish bias, then we are always targeting a premium array. If we have a bearish bias, so a bearish intention, then we always target a discount array. That is important. So the fair value gaps just very simply told us right there that the bias was bullish. So the direction, the intention was overall bullish. All right, that's interesting. Now, if we now do something even more interesting and we mark out the swing lows, every swing low that was responsible for the fair value gap. So this fair value gap right there got created by this swing low, because that's the most recent swing low that came before the fair value gap being created. So this fair value gap got created by this swing low right there, because that swing low came before the fair value gap was created. This didn't create a fair value gap right there. It was this swing low. Now, every swing low, pay attention, because every swing low right there did what? It got respected. Every swing low that created the fair value gap got respected. As in, it did not get traded below. It got respected, and we followed through higher with a new fair value gap being created. That is interesting. What have we just done? You now understand bias and narrative, because we have just gone over bias and narrative. Now, that's not the only thing you'll see of bias and narrative, because the full analyst week is about bias and narrative. But this is the first step to understanding bias and narrative. Because right now, the bias, the intention of price, was shown by the fair value gaps higher. And then we also had narrative, with narrative being, if we are going higher, where are we likely going higher from? So narrative equals the PD array that will allow price to move into the established bias. So in other words, to make that a little bit easier, if you have a bullish bias, then the narrative will be the discount array that will push price higher. So how will we deliver there? That's the narrative. So a bullish bias right here, and then we have a narrative. The narrative can be the fair value gap right there that will push price higher. As long as we understand, we have, or if we understand and we think right here, well, we have a lot of fair value gaps right there. Yes, that is correct. So where are we going higher from? Well, we have so much fair value gaps. What do we choose from? Well, by showing you that the swing lows are protected when they have a fair value gap higher, that shows you that you already filtered right now, that in this leg, you already have a limited choice right there. You have this fair value gap or that fair value gap. And this fair value gap, and why did I choose that fair value gap? There's a very specific choice for that, which we'll go over in a few minutes, so don't worry. But this already filtered out a lot right there, which then creates your narrative. So if we are going higher right there in this leg, then where are we going higher from? Your only choice right there is almost that fair value gap. It's almost your only choice. So then it becomes very easy because you understand that this swing low created that fair value gap. So this swing low will not get disrespected, as in it will not get traded below to then continue higher because it has a fair value gap in a leg, which we can very nicely see right here, because this low did not create a new fair value gap higher. So this low is then what? Is a target. This is now the discount rate that we want to continue higher from, this low right there. And that is, again, that narrative. So then we have the bias, the direction, and we have the narrative. Where are we going higher from? Where are we going lower from? How are we going to get? How are we going to deliver towards that bias? That is important. Now, I can probably hear you think as well, and it's a great question right here, that we also have bearish fair value gaps. So if you talk about intention and direction, and we have bearish fair value gaps, then why did you not look at them? Because that showed you that we wanted to continue bearish, right? Because that's clearly bearish intention right there. And you are correct, that is indeed bearish intention. That leads me to the next point though, because now we need to understand the timeframes. Understanding the timeframes comes at an understanding first of why we use certain timeframes. Institutions and big players that I refer to as institutions, etc., they refer to the higher time frame always, because the orders are too large to get filled in on a 1 minute time frame, on a 5 minute time frame. It's not going to work. So the higher time frame is something they are referring to. The higher time frame is the 4-hour time frame and above. So that is the 4-hour, daily, weekly, and monthly. Now, you only need the monthly, weekly, daily, 4-hour, 1 hour, 15 minute, 5 minute, and 1 minute time frame to your disposal. You don't need anything more. You don't need anything less. Well, you can use less if you want to, but you don't need anything more. That is quite important. Now, with anything less, I just refer to what entry pattern you want to use and what entry time frame you want to use overall, which is something we're going to go into later. But I don't want you to not use the monthly, weekly, daily, 4-hour, and etc. We need to use these exact time frames right there. Now, if you're later on going to confirm a 1 minute trade or a 1 hour trade, that's up to your personal liking. And that's something we're going to go into later on. But that's what I need you to understand, that these time frames, just use those time frames. Just blatantly copy me. So right here, why we need to understand that is because the higher time frame will rule. As in, if we have a monthly fair value gap and we have a weekly fair value gap, then the monthly fair value gap is the stronger fair value gap. Because the higher the time frame, the stronger the fair value gap. So that is important to understand first of all. And then we need to understand how we can sort of maneuver within the time frames itself. So if we zoom out a little bit and we first go into the monthly time frame, then we can see that we have a monthly fair value gap right there, higher. So overall here, what we already saw on the monthly time frame is that we just have bullish intention. So on the long term, we are just bullish right here. Which, if we then go into the weekly right there, we also see this weekly fair value gap being created right there. Shows bullish intention. Then, the most important one is this weekly bullish fair value gap right there. All right, that is quite interesting. Because that right there shows us bullish intention. Okay. So at that moment in time, once we have this bullish weekly fair value gap, we now have a lot to play around with. Because we can trade towards that weekly fair value gap. We can also trade off of it. And if we are bullish, so we again start with the foundational levels. We start with the bias. We are bullish right now because we have that bullish fair value gap. So that tells us the intention is bullish. Perfect. Then we want to target a premium array. What did we went over? What did we go over? A premium array is that previous week high right there, which creates this narrative as well. Because if we are going higher, where are we going higher from? What are we going to target then? All right, we have this discount array, that fair value gap, that is where we're going higher from. We have that previous week high to then target right there. Okay, that is very, very interesting. So that already led to our bias and our narrative. Okay, so right now, why did those bearish fair value gaps not hold? Because we are pushing higher off of a weekly fair value gap. So we need to understand what the higher time frame is telling us first. So that is why you saw me go from the monthly to the weekly right there. Because if we had a monthly fair value gap right there that we already came into, then I wouldn't go into the weekly right there because I already understand that the higher time frame rules. So the weekly here rules. So same example, if we go into the daily time frame right here, what do we see? We have this bearish fair value gap that is sitting right there. Small daily bearish fair value gap right there. Okay, that is quite interesting. Now, why did that daily bearish fair value gap not hold? Because that daily bearish fair value gap, right, that showed intention. That showed intention. And Ajor also just told me right there that swing lows with fair value gaps in the leg right there, they should hold, right? Yes, correct. But this is where the understanding of timeframes comes in, which is a skill in itself, understanding timeframes and where the fair value gaps are. This is going to take you a while probably to fully understand, because once you are live trading, this is going to be constantly monitoring what are the fair value gaps doing. And again, understanding the monthly is not that hard, because a monthly fair value gap gets created in what time? In 3 months time. 3 months to create one fair value gap on the monthly time frame. And you're telling me that you don't have the time to look at the monthly constantly to monitor that. You only need 1 minute right there. You only need 1 minute. And I don't, when I refer to that is, I've heard people say in the past that, do you really need the monthly, etc. to trade the 1 minute? And yes, you do need it. You do need it because you need to be aware of it overall. And the only excuse that I see to not use the monthly is just being lazy. Because if you can't find 5 minutes in those 3 months time to figure out that there's a monthly fair value gap being created, then what are you doing? That's just me. That's just being lazy, to be honest. But so that is why it's very important. Yes, you also need to take into account the monthly. Yes, you need to take into account the weekly. Yes, the daily. Yes, the 4 hour. Yes, the 1 hour. Yes, the 15 minutes. But it's all going to make sense. So don't worry. So right here, why did that daily fair value gap not hold? Because the weekly time frame right there, which is above the daily time frame because it's the higher time frame, so it's above the daily time frame, is the stronger one. So the higher the time frame, the stronger the time frame. So right here, this weekly fair value gap was a stronger magnet for price to come into, and it was also a stronger rocket, a stronger bounce pad to continue higher off of right there. Because this daily fair value gap, of course, is on the time frame below the weekly fair value gap. So this has less power. It has less rights, you could call it, in the marketplace right there. Which is also why these daily fair value gaps right there didn't get respected. Because they don't have much to say, because we have a weekly fair value gap just below it right there. So that is why we go over first the monthly, weekly, daily, 4 hour. Do you need to do that for every single trading day? It's also something we're going to touch on later on. Don't worry. So that is why we need to understand that. And this is also where it gets interesting, because so the next part is to understand that we have that 3 candle pattern, which we talked about. Because right here on this daily time frame, we can see 2 fair value gaps being created, where we have this fair value gap, the lower fair value gap right there, and we have the higher fair value gap. Can you see a difference in the third candle of the fair value gap? The third candle of the first fair value gap being this candle, the expansion, a new expansion candle right there. Where the third candle of the second fair value gap higher, which is this one right there, is doing what? It's a consolidation, it's a bearish candle right there. That indicates in itself already that price is taking into account the fair value gap that is being created right there, because it wants to trade into it right there. That is important, because price, when it moves higher, creates fair value gaps. It's not that it ignores those fair value gaps. No, price already predicts and anticipates the fair value gaps being created in the future. The future fair value gaps are already taken into account. That is the same thing that we want to do right there. So we also want to already take into account the future fair value gaps that are being created. So right there, once we have this daily fair value gap being created right there, and we have a candle like this, that is where the third candle, which is what we're going to touch on in candle signs, is a little bit tricky to trade. Because that third candle is preparing price. It's already taking into account the daily fair value gap it's creating right there. Will we push higher off of that daily fair value gap? No, not right there. And we can see why, and that's something we're going to go into in candle signs later on. But right there, because very simply said, we also have this weekly fair value gap below it. So there's a higher probability of coming into that weekly fair value gap to then continue higher. So right there, we have the daily now in context. The daily is in context of the weekly time frame, because everything that's happening on daily, we can basically ignore right here, because we're just looking at higher prices of this weekly fair value gap right there. All right, interesting. Then the next part is the 4 hour. So what can we see on the 4 hour? And now you can see the reason why I marked out this 4 hour fair value gap, because it's the same premise as that we just used on the daily and the weekly time frame, where if we go into the 1 hour, we saw these 1 hour fair value gaps right there. Those 1 hour fair value gaps did not hold. Why? Because there's a 4 hour fair value gap below those 1 hour fair value gaps. Again, the higher the time frame, the stronger the magnet and the stronger the bounce pad. So that is important. The stronger everything, the higher the time frame, the stronger the PD array in itself. So right there, we can see that we are now following through on just 4 hour fair value gaps overall. Now it gets very interesting, because if we go back into the 1 hour right here, on the 1 hour, we can see that we had this fair value gap being created right there, which we can again see with the 3 candle pattern that we overall talked about. But if we read the story that goes before it actually, because we understand that this daily fair value gap right there that we had just determined, this daily fair value gap, these daily fair value gaps are likely not pushing price higher. All right, that's quite interesting. So what is it reaching for? That weekly fair value gap most likely. All right, so that creates what? That creates a bias. Because you've now established a bias. Short-term bias is trading into the weekly fair value gap right there. Which on the 1 hour you can perfectly see. Because on the 1 hour, you see the fair value gaps, the bearish fair value gaps right there, pointing towards the weekly fair value gap. They are telling you, hey, we want to trade into the weekly fair value gap right there, which is exactly what we're seeing right here. Fair value gap respected. With respected, I mean that we are continuing lower. We are creating new fair value gaps lower off of that. Then right here, what are we seeing there? Fair value gap right there. And maybe you're sticking into that one as well. Getting respected with what? The mitigation block right there, which allows us to have more accuracy, which is why we are not using this fair value gap right there, which is why we're using that one. So that allows us to have more accuracy, and which is also the reason why we wouldn't want to use a fair value gap that is very high in this leg. Because there's no reason to come back above those fair value gaps that are overlapping with the PD array. That's something we're going to go into as well. Then the next part is that we have this fair value gap sitting right there, which we see we have a sting into and we continue lower, creating what? A new fair value gap right there. That new fair value gap that is trading lower right there, that is then again your new narrative. Where are we going lower from? Well, this fair value gap right there, which is this swing high, leaves behind that swing high, and then we continue lower off that, knowing that we won't come back above this high right here. And then we continue lower off of that, then we reach the target, which is the weekly fair value gap. And what can we see right now? Let's pay attention to the details. Because right here, we can see this 1 hour fair value gap is now not creating a new 1 hour fair value gap lower. Okay. So again, we already knew that the weekly fair value gap might have a rejection, etc. But how can we confirm this? This is now getting very interesting because right now, this did not create a new fair value gap lower. So we create a new bullish fair value gap higher. So what is the intention? The intention overall at that moment in time is being bullish right there, with knowing that the weekly fair value gap is sitting right there. So then we eventually push higher, create new fair value gaps right there, trade into this fair value gap as well. That is overlapping actually with that high, or not exactly overlapping, but we have that high that we also trade into, which leads me to the next point right there, because we had this 1 hour fair value gap, but we also had the 4 hour fair value gap sitting right there. And you just told me, Ario, that if we have this 4 hour fair value gap, then we might want to trade into that. Yes, this is where the 3 candle pattern, where that candle signs, which we're going to go into later on as well, becomes very interesting. Because right here at this moment in time, look how this next candle closes right there. That next candle, is it prepared? Is this candle being prepared to trade into the lower fair value gap that is sitting right there? No. Because compare this candle to, for example, a candle like this candle, where it's trading very high, long wick. This is just expanding right there. So it's not preparing price to trade into that 4 hour value gap to then continue higher. If it happens, it happens, and we look to trade off of that. But that is a first sign that we do not want to come into that fair value gap lower right there. And we already want to continue off this 1 hour fair value gap right there to then continue higher. So that is when you don't see that fair value gap being traded back into, which leads me to the next point. Because right there, this fair value gap is the daily fair value gap, which we're coming into right there. So we're coming into that daily fair value gap. But as we can see at that moment in time, we also could make the argument that we are not preparing to trade into this 4 hour fair value gap right there, which I would definitely agree with you. The only difference is that we're now coming into something on the time frame above it again, which is where you can expect that rejection of that fair value gap, that bearish fair value gap. And then at that moment in time, you are reading the fair value and the liquidity story again. This fair value story is, the first story is that we're coming off this daily fair value gap. All right, we have this daily fair value gap. We have this bearish 1 hour fair value gap. We have this 4 hour fair value gap. So there's a lot of premium and discount arrays in the form of bearish and bullish fair value gaps in close proximity to one another. This is extremely 50-50 price action, because clearly there's not one in control. The only argument that we have right here is that we have this weekly fair value gap higher right there. So that weekly fair value gap is still the stronger one. So if anything, then the longs, the bullish price action is still more favorable, which we can now also see that we have the sting into the 1 hour fair value gap right there, which failed to create a new 1 hour fair value gap lower overall, which then led to coming into that daily fair value gap again right there. Coming into a daily fair value gap, coming into any fair value gap twice is not something I would want to see. Why is that? Because we understand the basics of fair value gaps, and the fair value gap itself is, again, fair value. As in, there's not fair value in the first fair value gap. So we only offered buy side in this bullish 4 hour fair value gap that is sitting right there. All right, and we know that. So now we are going to offer sell side in that. So once we offer sell side in that, there's no reason to come back into this 4 hour fair value gap right there. So the first time it came into that and it already expanded higher, tried to expand higher, it's already sort of being used up. So it's a discarded discount rate. So it's not a discount rate you would use a second time. Knowing that is that this daily fair value gap as well, coming into it a second time, coming into a third time right there, is not a fair value gap that we now want to use as a premium array anymore. And that is very important to understand a boundary and a context and narrative as well. Because this is not something you would want to trade off of, which also leads to it not being a premium array, which also leads to then, all right, that means that we don't really have anything to push price lower right there anymore. So if this is not getting respected, then clearly it is still having bullish intention. We create a new bullish fair value gap right there, and then we continue higher off of that. And that is how you read the fair value gaps, because this fair value gap has already been offered fair value. So what I mean, and when I refer to price is not pushing, is not creating a new fair value gap lower or higher, same example right here, this bearish fair value gap is not creating a bearish fair value gap lower off of that. So if it's not doing that, then it has already offered fair value, and we likely got a slow, some kind of rejection right there, potentially lower a little bit. But it already offered fair value. It doesn't have to offer fair value twice. That's not a thing. When an imbalance, the same as a fair value gap, when there's an imbalance, means there's an imbalance in a market which needs to get balanced. We can only balance it once. It doesn't need to be balanced 500 times. No, we balance it once. So if it doesn't continue after that balancing has been done, after that fair value has been given, then that indicates that we are now not, or that we are now continuing higher when this happens, and we are continuing higher, and that this daily fair value gap is not strong enough to push price lower. The 1 hour fair value gap is not strong enough to push price lower. That is exactly what we are seeing right there. So that is the fair value gaps right there, and the lack of fair value gaps being created are telling us what? They are telling us that exact story. They are telling us a story of where price wants to trade towards. This is a pretty overwhelming concept in itself on fair value gaps, but this is exactly why fair value gaps are so extremely strong. If you understand the timeframes and you work your way down the timeframes and you understand where the fair value gaps are, etc., then you know the bias and you know the narrative by just understanding fair value gaps. So that is exactly what I would love for you to do, is create a story. You can just hindsight backtest. So how do we go about hindsight backtesting? It's the same way I did this, basically. The same exact thing I did right here is I just, in hindsight, I went over price action and I saw and I studied what happened. What is happening right here? Which fair value gaps are getting respected? Why are they getting respected? What is overall happening in price action currently? And that is how you create that hindsight backtesting case study. And if you understand that, then the fair value gaps are becoming a lot clearer. And this is the foundation of everything. Because if you understand this, then now we can go into order flow, which is, again, the foundation of everything. It's I always call it my baby. It's my concept that I'm very proud of. I love it, and I'm very proud of that concept, of that order flow concept. So that is what we need to understand next, and that is the beauty of it. But we first need to understand the fair value gaps right here. So please create those case studies right there. And please then feel free to share them as well with me, of course. And then next video, we are going to dive into order flow, which will be a major step as well. All right, perfect. Thank you.